What's going on, my beautiful finance and moguls? Welcome back to another episode of the Do.Different.Better Show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connective Institute, and managing director of the Integrated Capital Fund. Thanks for joining me today. Last week, we got knee deep into maximizing your 401k, 403b, and IRA contributions to building your financial wealth. I covered what they are, how they work, and why maxing out your contributions can add hundreds or thousands of dollars to your retirement fund. I also discussed strategies to maximize contributions, setting realistic goals, and understanding the contribution limits and avoiding common mistakes, as well as some tips to make the most out of your retirement savings. Today, we're talking about something that's becoming more and more common in workplaces, especially for those work environments that are in the tech, startup, and corporate world. And that is employee stock options and restricted stock units, or RSUs. If you're someone who's got stock options as part of your compensation package, or you're just curious about what they are, this episode is for you. You might have heard people say stock options can be life changing. Well, it's true. But here's the thing, they can be life changing if you know how they work. Understanding these options and how they fit into your overall financial picture can help make you make better and smarter decisions, both in the short term and in the long term. But by the end of this episode, you'll have a very solid understanding of stock options, RSUs, how they work, and what you need to know to make them work for you and not the other way around. So, what are stock options, employee stock options? First off, let's make sure we understand what these things are. At a very high level, stock options are part of a compensation package that companies offer their employees. Typically, they're at the higher levels, like director level or C suite level, meaning your CEO, your CFO, your CMO. But sometimes they'll be offered at the beginning of employment for younger companies because they are not able to pay at a certain level, and they want employees to have some vested interest in the growth and success of the companies. But they give you the right, the company gives you the right to buy company stock at a set price, or they might give you these stock options at a set price. That is called the exercise price or strike price after a certain period of time, known as the vesting period. Sound complicated? Don't worry, I'm going to break all this down. There are two main types of stock options that you'll hear about: incentive stock options, or ISOs, and non-qualified stock options like that are called NSOs. So first, let's start with ISOs. Incentive stock options, or ISOs, are typically offered to employees of a company as an incentive to stick around for the long haul. The beauty of ISOs is the tax treatment. If you play your cards right and meet certain holding periods, you could be taxed at the capital gains rate instead of a regular income tax, which could save you a nice chunk of change, right? Non-qualified stock options, NSOs, on the other hand, are offered more widely and don't come with the same tax benefits as ISOs. When you exercise ISOs, the difference between the strike price and the market price is taxed as regular income. However, NSOs can still be a fantastic way to grow wealth if the company's stock value takes off. So, now let's talk about some key terms you'll need to know to understand how they work. Number one, grant date. This is the date that you're given the stock options. Then there's the exercise price, the price at which you buy the stock once your options are vested. The vesting schedule. This is the time frame over which you gain the right to exercise your stock options. A typical vesting schedule might be 4 years with a 1-year cliff, meaning you have to stay at the company for a year before any of your options vest, And after that, they start vesting monthly or quarterly. All of this will be written out in a contract. You don't have to worry about remembering it. It'll all be written down. So if you find yourself in that situation and you have a financial advisor, this would be something good to bring to your financial advisor and say, what does this mean for my financial goals that we've set or that we've talked about? And they can tell you, like, what does it mean? What are the implications? What you need to be concerned about, and how you might be able to avoid some of those concerns. The last piece is the expiration date. Stock options don't last forever, hence why they're called options. There's usually an expiration date after which you lose the right to exercise the option, right? So think about, I'm going to give you an option that's available for 30 days, 60 days, 90 days. Normally those times are longer, but I just want to give you an example. Like, I want to give you something contextual to wrap your head around. But let's break down a real concrete example. Imagine you're offered 1,000 stock options at a strike price of $10 per share. Your company's stock is currently trading at $10. So there's no immediate gain, right? You're buying it at the same price that everybody else is buying it, right? But 2 years later, the company has grown, partly because of your contributions, and the stock is now worth $50 a share. Since your stock options are vested, meaning you've stayed the amount of time to be able to exercise the option, you can buy 1,000 shares at $10 a piece, even though the market price is at $50. You exercise your options to pay $10,000 and now own shares worth $50,000. Not bad, right? The key here is understanding the timing and tax implications, which we'll talk a little bit more later in this episode. So now let's switch gears and talk about RSUs, restricted stock units. RSUs are becoming more and more popular, especially at big tech companies and some startups. So what are RSUs? Unlike stock options, RSUs represent actual shares of stock that you'll receive after they vest. Okay, meaning after you've been at the company for a designated amount of time. You don't need to purchase them or worry about an exercise price. Once your RSUs vest, they become yours, either as actual shares of stock or as cash, depending on what the company's plan or offer has been to you. The biggest difference between RSUs and stock options is that RSUs can be perceived as less risky. With stock options, the value of the stock could go up. And if that happens, your stock options could be worthless. If the value of the stock goes down, if that happens, your stock options could be worthless. With RSUs, the risk is a little bit lower because they're usually granted as part of a compensation package, regardless of the stock's price, right? So you might hear somebody say, hey, they got a $5 million compensation package. A CEO got a $5 million compensation package. 1 million of that is in stocks of the company, right? So they really didn't get $5 million. They got $4 million, which will be on payroll. And then they got another $1 million, which will be in the stock options. Now, there's usually a caveat. They have to stay at the company for a certain amount of time. Maybe it's a year, maybe it's 2 years, maybe it's 3 years. It may even be on a step ladder where they say, hey, if you stay at the company 1 year, you get this amount. If you stay at the company 2 years, you get this amount. If you stay at the company 3 years, you get this amount. But once again, all of that is discussed with you and written down on paper at the time that you are given an offer letter. That'll usually be outlined, all of that in the offer letter. So even if you don't have the particulars, you can take your offer letter to your advisor and say, this is what's being offered. What are the implications financially? Which you want to do because you might want to negotiate. You might want to say, hey, I actually don't want the $1 million of stock I don't want $1 million in stock as part of my compensation. Why don't you give me $500,000 stock and give me $500,000 cash? So now my salary will be $4.5 million instead of $4 million plus a stock option. So these are the reasons why you want to be like, I get my offer letter, really understand what are the implications of what's being put in the offer letter and how that positively or negatively impact your financial goals and your financial future. So now let's talk about vesting and payouts. Just like stock options, RSUs have a vesting schedule. For example, you might receive 1,000 RSUs, but they vest over 4 years. So I just talked a little bit about that. Once they vest, the company transfers the shares to you, right? So you might not have them, they're being held on your behalf, right? Until the vesting period ends. Or they might give you a cash equivalent to the value of the stock at that time. Here's the kicker though. RSUs are taxed as income when they vest, which means your tax base on the stock's value at the time you receive it. However, any gains beyond that after you own the stock will be taxed as capital gains when you sell it. So it looks like Mr. Skittles wants to join us today. So we'll visit with him for a little while we go through this episode. So here's an example. Let's say you work at a hot new tech startup, right? You're working at, Instagram 2.0. They grant you 500 RSUs over a 4-year vesting schedule. The stock is worth $20 per share, and you're granted the RSUs when you're granted the RSUs. Over the next 4 years, you stay at the company and the stock price jumps to $100. When your RSUs vest, you now own 500 shares worth $100. That's $50,000 in total. Now, you'll pay taxes on the $50,000 at your original income tax rate, whatever that is. If it's 22%, if it's 30%, if it's 8%, whatever your ordinary income tax rate would be. But any gains beyond that will be taxed as capital gains when you sell those stock, not at the time you're holding the stock. So let's say you hold the stock for another year. You won't be taxed at that moment. You'll be taxed when you sell it. Or at the very least, what will happen is you will have to declare that income, and when you file your taxes for the next year, that will show up as part of your income for the year before. And then Uncle Sam will be having their hand out asking you to pay, right? So RSUs can be an excellent wealth building tool, just like stock options. Understanding when you sell and how to manage the tax implications is really critical. So your accountant and your tax advisor, these are the folks you want to bring into this conversation to help you, right? All right, folks, that's your crash course on employee stock options and RSUs. Don't worry, we're going to dive a lot deeper into all of this and how to maximize these benefits and avoid some common mistakes in the next segment. Excuse me. I don't want you to go anywhere. We are just getting started, but up next, we're going to explore how to evaluate whether or not to exercise your options, to hold or sell, and the tax strategies that come into play. You're listening to Do Different Better with Elaine Rasmussen. Stay tuned, and I will see you after the break. And we'll see if Mr. Skittles is going to join us after the break. Hey everybody, what's happening, my savvy financiers in training? Welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen, and if you're just tuning in, we are doing a deep dive into the world of employee stock options and RSUs. In the first segment, we covered the basics. We talked about what are stock options and RSUs. We talked about how they work. But now it's time to talk about the fun part. You're like, Elaine, is there really a fun part? Yes, there is a fun part. How to maximize the value of these benefits and make them work for you. So now you've got stock options sitting in front of you, and they're vested, meaning you've satisfied the requirements, the length of time that you need to be employed at the company to be able to capture the value of the stock options, either in cash or in stocks that then get transferred to you. Now you're faced with the $1 million question. When should you exercise these options? So let's break it down. Exercising your stock option means you're buying shares of the company's stock at the strike price or exercise price that we discussed in segment 1. The price was set when the options were granted to you, and it's usually lower than the current market price, right? So whatever the price is that's trading on the stock exchange, your price oftentimes is going to be lower than what that price is, right? The current price that it's selling for to the general public. Exercising is how you turn these options into actual shares that you own. But here's the kicker. Exercising isn't free. You have to pay to exercise you have to pay the exercise price to buy the shares, and depending on how many options you have, this could be a big chunk of change. On top of that, you'll need to think about the tax implications. Exercising options could trigger taxes depending on the type of stock option, an ISO or an NSO, and whether or not you plan to sell the shares right away. So, when is the best time to exercise your options? Well, when the stock price is low, or are you holding out in hopes that it will rise even higher? Timing the market obviously can be tricky. It's kind of like knowing what number is going to come up on the roulette wheel. You got to make some guess. Now there's probability, right? But if you're not a mathematician, that's going to be a much bigger hill to climb. Okay. So here are a few things that you want to consider in thinking about what's the best time to exercise your option. And while there's no one size fits all, here are some things you can consider when making your decision. Number one, market price. Are you exercising when the stock price is low? Are you holding out that it's going to rise even higher? Timing in the market can be super, super tricky. Number two, the vesting schedule. Have all of your options vested, or do you still need to wait for some of them to become available? So remember, I talked about this step ladder. You may have a step ladder approach to your vesting. You might get a certain amount at different points of time of tenure that you've had with the company. And then the third thing is the tax implications. Will exercising your options trigger ordinary income taxes? Are you better to position yourself to wait and pay capital gains taxes later? So let's give you a scenario so you can kind of really understand how all of this might work. Let's say you're granted 1,000 stock options with an exercise price of $5 per share. Okay. The company is doing well, and the stock is now worth $20 a share. If you exercise now, you'll pay $5,000 to buy shares that are now worth $20,000. On paper, that's a $15,000 gain, right? If you believe the stock will continue to rise, you might decide to hold on to those shares. But if you need to liquidate, right, meaning sell and get the cash, you could end up with shares that are worth less than what you paid for. And that may not be what you want, but you may have no choice because of your life circumstances, right? So these are the things you want to think about, okay? So, all right. You've exercised your options, or maybe your RSUs have vested. Do you hold on to your shares for long-term gains? Maybe these shares are part of your retirement plan, or do you sell them right away? Let's weigh the pros and cons. Some employees choose to hold on to their shares, especially if they believe the company's stock is going to continue rising. Maybe you are on the brink of some new technology or some new framework or some new platform or some new way of doing the thing that you all do that could have wide scale implications and wide scale appeal. Well, you might say, I'm going to hold on because the stock price, I imagine, is going to go even higher, right? But you're also taking a risk because anything could happen, right? The CEO might be brought up on charges for embezzling or sexual harassment, right? Which is now going to drive down the price. So once again, this is why you want to be mindful of what is the landscape and where are you playing. But holding always allows you to benefit from the potential stock appreciation over time. And if you hold for more than a year, you could qualify for the lower long term capital gains tax rate over being taxed at your income tax rate, which could be at a higher level. Plus, holding on to the shares shows that you believe in the long term success of the company. But remember, just like with any investment, there is risk. What if the stock price the stock price tanks? You could lose a lot of value that you've worked so hard to earn, right? Once again, bringing in your wealth advisor or some other expert, if you have a family member or someone else that can help you think through and talk through some of your options, it's definitely something you should do. Now, on the flip side, selling can make a lot of sense if you have an immediate financial need or you want to diversify your portfolio. Selling could provide you liquidity for a big purchase like a house or help you build a more diverse portfolio rather than having all of your eggs in the company's basket, right? But here are some factors I want you to consider when you're deciding to sell. First of all, your liquidity needs. Do you need the cash for something? Maybe you've been waiting to make a big purchase or you're looking to pay off a big debt. Maybe you'd like to pay off the last $20,000 or $30,000 of your house so you can be free and clear. And then that way you don't feel like you're tied to this job if it doesn't work out because your house is now paid off, right? Maybe you're looking to buy an investment property that is going to set you up financially for the future. But once again, maybe you've got a big piece of debt, you want to pay off some student loans, whatever the case may be, this is something that you can take into consideration. Number two, the company's performance. How is the company actually doing? Is there a lot of infighting in the organization or is everybody hitting their quarterly goals? The company's doing really well. People love working there. Do you believe in the long-term vision of the company? Are you unsure about its future or your own, right? And then number three is market environment. What's going on in the stock market or the broader economy? If you think a market downturn is coming, it might make sense to sell now and lock in your gains. A lot of things we're coming up against the election when this episode airs. We might either be just before the election or just after your election. Some people are holding off making big financial decisions to see what will be the implications of the new administration for the economy, right? So these are things that you want to take into consideration as you're thinking about, do I hold on to my stock options or my shares, or do I sell them? Holding on to shares can lead to greater rewards if the stock continues to rise, but also it comes with risk. So the longer you hold, the more you expose yourself to market volatility, company specific risk, like I said, like something going on with management or potential downturns either internally, economically, or globally. Selling offers immediate liquidity and less risk, but you could miss out on future gains. So you're really just going to have to weigh the situation and make your bets, right? Okay. So now let's put all of this together. Here's a simple decision-making framework you can follow to decide when to exercise, sell, or hold your stock options or RSUs. One, exercising. If the stock price is significantly higher than the exercise price and you can afford to pay the exercise cost, meaning what the value is of the stock at your price, it might be a good time to exercise, right? But also factor in the taxes that you will have to pay, right? Two, selling. Consider selling if you need liquidity or you want to diversify. If you're worried about the company's future, that might be something that you want to think about, or the future, the stock market, locking in your gains could be a smart move for you, right? So then there is holding. Hold if you believe the company will continue to grow and you're okay with taking the risk. Just make sure you're not overexposed to a single stock. So once again, you might have a 401k. So we talked about 401ks and 403bs. in the last episode. This is just another layer in your financial lasagna pie, right? So you might have stock options, you might have a 401k. The 401k is typically not invested in the company, but your 401k, particularly if it's a tech company, might hold stock in the company. So just really understanding, and a lot of times you won't know that because once again, when we talk about 401ks, your money is being pooled with a whole bunch of other people's money, not only money of the people in your company, but money of other employees in other companies. 401ks are made up of employers and all the employees in those companies who have decided to invest in the 401k plan, right? So what you want to weigh is if you've diversified your portfolio, meaning you have your 401k, you may have an IRA account, you have these stock options, all of that is going to play into the factor of, do I want to hold these? Do I want to sell them? When do I want to sell them? Do I need to sell them? You may not need to sell them, right? If you've got a great diverse portfolio that's made up of all of these things, you might have a real estate investment property along with your 401k, along with your employee stock options, along with a Roth IRA. You might be like, hey, you know what? I'm just going to hold, and whatever downturn comes, I have enough cushion with my other investments that I can manage whatever blow I might get or any losses that I might get with these options. But the big thing to understand when you decide to exercise options is now you're going to pay for those options. They are not yours until you pay for them, right? So once again, you want to think about, hey, can I even afford to buy these stocks? That might be the deciding factor of whether or not you keep the option open. But once again, like I said, options usually have a period of time or redemption period of when you can exercise that option. So these are all the things you want to plan out and map out. A spreadsheet is good for this by being able to look at something over time longitudinally to be like, what triggers might happen, and you can play scenarios to see what the implications might be. And your advisor and maybe even your tax accountant can help you understand what might be those implications as well. So here is your homework. If you have stock options or RSUs, review the current arrangement. A lot of times you're going to be getting this as part of your compensation package, and it's new and it's exciting, and all the things that they're telling you, what your compensation is, where your office is going to be, what are some of the perks. You may not have heard all the information related to your stock options or RSUs. So now that a little time has passed, pull out that documentation. Sit down with human resources if you need to, or your supervisor or director, and say, I just want to go through this again and make sure I understand everything that's in here. Are your options or RSUs fully vested, right? So looking at what does that look like? Have you met that requirement, right? And if it's not written down, which it should be, finding out when that time is. And if you don't have that in writing, I would definitely ask for it in writing. It would be uncommon for it to not be in writing, but sometimes with startups, they do things a little bit informally. They do things on a handshake. So once again, get it written down in paper, even if you're only documenting it in an email of like, here's my understanding of what my options are, when I have to pay, when I have to redeem them, what it's going to look like, what are the terms, right? Even if you don't have something in writing, write an email to the senior leadership outlining what your understanding is and asking them to clarify whatever any misunderstandings that have been documented in that email. Now at least you have a paper trail that says, yes, this is my understanding. Management or leadership has agreed that my understanding is correct. And then you can go from there, right? But things you want to add in that is like, what's the stock price compared to your exercise price? By applying this framework that I just talked about and decide whether it's time to exercise, sell, or hold, or when you want to do that. It's all about maximizing the value and making these benefits work for you. You want to be sure you want this to be an annual exercise that you do by yourself with your partner or with your financial advisor, and maybe all three, just so everybody is on the same page. Okay. All right, folks, coming up in the next segment, we're going to dive into the advanced strategies like the back door and some common mistakes. So I want you to stick with me while we secure your financial success and make you future financial bosses. We'll be back in a moment, and I will see you and I'll help you do different better. Welcome back, my future millionaires. You're still tuned in to Do Different Better. I'm your host, Elaine Rasmussen, and we're going to go deep into the nitty gritty of stock options and RSUs. In this segment, I'll talk about one of the most important and often misunderstood aspects of stock options: taxes. I know, taxes aren't exactly the most exciting topic, but they are super important when it comes to maximizing the value of your options and avoiding any nasty surprises. So, buckle up, because we're going to make this as fun and as easy and to understand as possible. I'm going to do my best. So, let me know how I do. Okay. So, let's kick things off with the basics. Taxes on stock options and RSUs can be tricky because they depend on a lot of different factors, like the type of stock option you have and when you exercise or sell your shares. But first, let's break down how incentive stock options, ISOs, and non qualified stock options are taxed differently. Okay. ISOs, these are usually reserved for employees and have more favorable tax treatment if you follow the rules. When you exercise ISOs, you won't owe ordinary income tax right away, but you might hit something called an AMT. If you've ever filled out TurboTax, they're usually like, hey, do you have an alternative AMT, an alternative minimum tax? And you're like, I don't even know what that is. And you just be like, doesn't apply to me. Well, if you've got stock options, now it could apply to you, right? If you hold on to your shares for more than a year after exercising and 2 years after the grant date, you can sell them and only pay long-term capital gains tax, which is lower than the ordinary income tax most of the time. NSOs, unlike ISOs, don't have the same tax advantage. When you exercise NSOs, the difference between the exercise price and the market price at the time of the exercise is considered ordinary income. It would be like you got a raise that year, or you got a bonus, or you got some kind of compensation, or even like your reimbursement. If you get reimbursement for work, it is tax, right? And you'll owe taxes on that amount. When you sell the shares, any additional gains are subject to capital gains tax. So if you want to think about it as like a double taxation, you can, meaning that a certain portion is going to be taxed as income tax, and then the next portion is going to be taxed as capital gains tax, right? Which is a different rate. You may be sitting at a 16% tax rate, but the capital gains rate is actually set. It's not income contingent, right? Okay. So let's unpack AMT, the alternative minimum tax. This tax is designed to make sure high earners pay their fair share, even if they have lots of deductions and tax breaks. When you exercise ISOs, the spread, or the difference between the exercise price and the fair market value, can trigger AMT. You might end up paying taxes on paper gains, even if you haven't sold the shares yet. That's why timing is everything when it comes to exercising ISOs. RSUs work a little differently. You're taxed when your RSU vests, not when you sell the shares. The value of the shares at vesting is considered ordinary income, so you'll pay taxes at your regular income tax rate. After that, any gains or losses from holding or selling the shares are subject to capital gains tax. So you would end up paying 2 layers of tax when they vest and again when you sell. So let's look at a simple scenario. Imagine you have 1,000 NSOs, right? With an exercise price of $10. The stock price is now $50. When you exercise, meaning you actually buy the shares, you'll pay taxes on the $40 difference as ordinary income. That's $40,000. So now, let's say you make $100,000, you're now going to be taxed as if your income was $140,000. Okay. If you hold the stock for a year and it goes up to $70 a share, you'll pay capital gains tax on the additional $20,000 when you sell, not at the moment that it happens, but when you sell. Understanding when to exercise and sell can have a huge impact on what you keep. But also remember, those gains can be rolled into a Roth IRA, depending on how much they are and the maximum, you haven't met your maximum contribution. So excuse me. So even with all of these, I don't mean to scare you with the tax implications, because there's even ways to even defer the taxes again by rolling it into some tax advantaged accounts. And I did a whole show on tax advantage accounts like 401ks and Roth IRAs and traditional IRAs. So take a listen to that. So, all right, now that we know how taxes work, let's talk strategy. How can you time your exercises and sales to minimize that tax bill? One of the best ways to reduce taxes on your stock options is to plan when you exercise and sell. For example, with ISOs, if you're able to hold on to the shares for at least a year after exercising, meaning you bought the stock, and 2 years after the granting period, which usually happens at the time that at a certain earlier point in time, maybe when you were hired or some other point in time, you'll only owe long-term capital gains tax, which is typically lower than ordinary income tax. So also pay attention to the calendar. If you're close to the end of the year, you might want to delay exercising until January to push any taxable events into the following next year. So remember, you're going to be, once December 31st comes or January 1st comes, you're taxed on any income that came in. And when you file your taxes at the April 15th date, you're paying taxes on what you earned in the previous year. If you sell in January, you're not dealing with that till the January of the following year, not the April of that year. So hopefully that makes sense to you, right? And this way, it gives you time to prepare financially and maybe even lower your tax income for the current year by implementing some other strategies, maybe selling some other stocks you have or leveraging some other tax advantaged opportunities, right? If you're selling shares and don't immediately need the cash, consider reinvesting into a tax advantage account like an IRA or a Roth IRA. This can defer taxes on future gains and help you build your wealth tax efficiently, right? Meaning you're minimizing the amount of taxes that you're paying on your portfolio. So here's an example. Let's say you exercise some NSOs and end up with $10,000 in proceeds after selling the shares. If you invest that $10,000 into a Roth IRA, you won't owe taxes on any future gains. Compare that to a regular brokerage account where you'd owe capital gains tax every time you sold the investment. Over time, those tax savings can really add up, and you're keeping more money to invest and compound over time, right? So now let's zoom out and talk big picture. Stock options and RSUs can be a powerful tool for building wealth, but only if you have a solid plan. So once again, this is where a wealth advisor or financial advisor or a certified financial planner can be really helpful. One, they know a lot of these things right off the top of their head. This is all new to you. This is a whole new language, a whole new universe for you. And if you want to nerd out and learn it, great. I love that for you. That's amazing. But definitely learning alongside a professional, because they're going to know these limitations and potholes automatically off the top of their head because this is what they do every day for a living. So they can help you navigate and be like, well, if you do this, think about this. If you do that, think about this. If you do this, this could happen. If you do that, this can happen. And they can run through those scenarios relatively quickly instead of you sitting in and Googling for hours and hours and hours on end, right? So as tempting as it might be to hold on to all your company's stock, it might be just as important to diversify the portfolio, right? So remember, it's risky to have too much of your wealth tied in one company, whether that's in a portfolio or whether that's in your own company stocks. If the company hits hard times, you could lose both your job and a big chunk of your wealth. So this is why it's critical to sell some of the shares and reinvest in other stocks like bonds or real estate or other investing opportunities. Your stock options and RSUs should fit into a broader financial plan. Remember, we talked about a financial portfolio lasagna, right? Different layers. Whether you're saving for retirement or a down payment on a home or your kids' education or maybe your own education, you might want to make sure that the decisions around your stock options align with those goals. For example, you may decide to exercise options early if you're planning to retire soon, right? You might be working at a company, but you're kind of getting towards the end of your full-time working life. So you might want to sell sooner and minimize taxes, or you might want to hold on to them longer if you're not relying on them for any near-term income, right? So this is all like really, really important. I can't stress to you enough. This is a lot to take in if this is all new to you. You might be working at a startup where they're talking about giving you stock options, and it's no time like the present. If the company's even talking about giving you stock options, start asking questions, start thinking about what that might mean. How much are they looking at? What is the current stock price of the company? And be engaged in those conversations. And if you are offered something, now you kind of are a little bit more prepared because you've been watching what's been happening and listening to what's been happening as the company talks about what they're thinking about. And you maybe have part of the conversation of informing what it looks like, your stock options, and not only for yourself, but the other employees. But it's a really great opportunity, and it's becoming more and more commonplace, particularly with tech companies, that they're offering these to employees, particularly in the way of compensation until the company gets to a certain point, or that they would do what's called an IPO, which is an initial public offering. Here's the other thing to know. You might not be able to sell your shares all during that period while the company is either going through getting ready to IPO, and a certain amount of period after the company IPOs. You may not be able to sell. So these are all questions you want to ask. Like, if we're going to be going into IPO, will there be a limitation on when I can sell, how many I can sell? It is not uncommon for it to be said, you can't sell more than X percentage of what you own. Right? If you've ever seen the television show Billions, that's what happens to the main character, Wendy, at some, I think maybe season 4, season 5, where she has to hold on to her stock options for a certain amount of time because they are going through some difficulties in the organization. So nobody is allowed to sell their stock. So these are the things you want to be aware of. Like, what are the limitations about when you can't sell the stock in and above what's already outlined in your documentation for your stock options, right? So here is my, just want to make sure I'm getting everything that I want to make sure I say to you. Okay, here's my call to action. If you haven't already, schedule a meeting with a financial advisor to go over your stock option or RSU plan. It's so important to get personalized advice because everyone's situation is completely different. And remember, a little bit of planning can go a really long way in making sure you keep as much as your hard-earned cash as possible, right? Well, that is a wrap for this episode. We have covered a lot of ground, from taxes on stock options and RSUs to advantage strategies for minimizing your tax bill and long-term financial planning. We also talk about what are stock options, how do they work, what should you be mindful of. But once again, these are a little bit more complicated financial waters. So I highly, highly, highly recommend you finding an advisor. Even if you don't have an advisor now, if you've been presented with a stock option, go talk to a couple advisors and see if there's somebody you would be comfortable engaging with you on a little bit longer term, you can always change your advisor at another time. You're not wedded to this person. So if you find like, hey, I don't know enough, but I like this person, go and work with them for a while and keep working with them until you don't want to work with them. All right. So join me. That's a wrap for this episode. We've covered a lot of ground, but I want you to join me next week for another action-packed episode of tools and tips and resources to help you understand your financial journey and see what the financial world has waiting for you. If you found this episode helpful, please subscribe, leave a review, and share it with friends who are navigating their own stock option journey. Thanks for tuning in to the Do Different Better Show. But before you go, make sure you hit the subscribe button and leave a review if you're loving what you're hearing. Let me know what you think of the show. We love comments. So tell us how this show has helped you. And if there's a money or finance question you have, if there's somebody you want me to interview, hit me up on LinkedIn or Instagram at Do Better with Elaine. And I will see you next week when I show you how to do different better.